The Fed says inflation may no longer be transitory and could rise further, and they may have to raise rates in 2 years' time. A warning shot to markets or pure central bank delusion? In the wake of these revelations, the Nasdaq hit a new all-time high, gold dropped by 5%, and Bitcoin has continued to slide below $30,000. Now, to try and make sense of it all, I'm joined again by Gareth Soloway of InTheMoneyStocks.com as we take a look at the technical analysis in this month's look at the charts. And remember, if you want to see more interviews with thought leaders and industry experts in financial markets, subscribe to Goldcore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store precious metals, visit goldcore.com, your precious metals experts. Gareth Soloway, welcome back to Goldcore TV.
Hey, thanks for having me back.
Now, we have seen some interesting moves since last time that we spoke. There's been a lot of rhetoric out of the Fed. We've gone from inflation being transitory to now they're saying that the surge in inflation may last longer than expected. And despite this, they're talking about potentially increasing rates in 2023. So keeping rates low for now. A lot of these things you would think are feeding into gold's hands, but yet we've seen a fair bit of a correction in gold. What are you seeing in the charts?
Yeah, so we certainly saw the Fed be more hawkish last week. And let's take a look at the GLD chart here. I think the gold situation initially created a sell-off here, and then you had kind of a deleveraging event where there were a lot of people that were over-leveraged on gold, and they had to start exiting those positions, which had this kind of caused this continued sell-off down here. Now, for me, I had sold my gold up in this range. It went a little bit higher, and now I started to rebuy my gold down here. On a technical basis, the pullback is a 618 Fibonacci retrace. So if you take this low here to this high here, this is a 618 Fibonacci retrace. And overall, I continue to remind myself even after this dip, and one of the reasons I continue to accumulate gold is that the key factors, the fundamental picture for gold continues to remain very, very bullish, which is basically that the printing of money is not stopping. And the Fed, even though they're slightly more hawkish, they basically walked everything back, which is why the stock market has gone back up. And they're basically saying, hey, listen, yeah, we may raise rates. It's a little, more inflation than we expect, but it's not going to cause us to react too much quicker. So I think the markets are taking that, at least in the short term, as a positive. And I think that's a good thing for gold.
They've painted themselves into a corner, really, haven't they? I mean, it's going to be very difficult for them to raise rates significantly with the level of money printing that's going on and the level of outstanding debt that there is.
Yeah, I don't honestly think they'll ever get us back to normal. For those of you that have followed the Fed for the last even 20 plus years, every crisis that we go through, the Fed drops interest rates. And then when we emerge from that crisis, they never get interest rates back up to the previous level. And so what this tells us is that, maybe the Fed will increase slightly, but at some point, whether it's a year from now or 3 years from now, you're going to have another crisis. Whether it's, it's probably going to be a collapse because of all the liquidity in the system and everything. And the Fed will then probably have to go negative on interest rates. I mean, it's just nuts how this continues to kind of play out. And the Fed, you're 100% right, is just kind of painting themselves into a corner where, yes, it's good for the short term. But as we know, for those of us that are parents, you give in the short term, you fight a bigger battle later on.
Yeah. And so what, any particular levels then you're looking for on the upside to signal that the bull trend is back on?
Yeah. So what I'd like to see is for gold to kind of shake off this recent down move and start to move up. I want to see us get back above this gap right here on the GLD. So back above 171, and then eventually take out this high here as well. One thing to keep an eye on here, and this is actually something I haven't talked about because it's so preliminary in any other interviews or even on my website or anything, but I do want to make a note here, is that you could potentially be forming an inverse head and shoulder pattern. And again, we need some things to go right here, but you can see over here, shoulder, head, and then could this be the beginning of a shoulder? And if we start to grind up, your neckline breakout would be right here. So I would say if you're looking for something in terms of the catalyst for a major rally in gold, If gold can go back up here and get above this trend line, you're literally talking about new highs on gold. You'll go even through this high here from 2020 and go even higher. So again, keep in mind that pattern is still forming itself.
And how does that translate then into spot gold chart?
So basically what I would say is spot gold, you could see easily $2,100 by year end on spot gold. And again, I would say the break point would be probably around, I'd want to see, and again, I'd have to translate this to get an exact point on the spot gold price, but probably around 1875 or so on spot. You get back above basically the recent highs, so the high there, you get back above that recent high, and that will be the catalyst for a move up on gold. And again, 2,100 is my year-end target. So I am obviously very bullish on gold from here.
Absolutely. And then silver, similar story?
So silver's a little trickier. Silver, I don't have a position in silver. We'll take a look at the chart here. And the reason why I'm kind of holding back on silver, now it still has a longer bullish pattern, but you can see this trend line here. I'm concerned you might dip a little bit more on that chart to tag that level. Right. And there's also a gap fill down here that I'm kind of watching carefully on the SLV chart. And again, on the spot chart, you're not going to see these gaps as clearly, but I do view them as good technical levels, even on the SLV chart. Now, my concern for silver, and I want to be clear, longer term silver is very, very rosy, right? So silver is going to go up probably $40, $50 in the next year or two. But my concern is that we have this monstrous reopening right now, and there's so much demand. So the industrial demand is there for silver. And I worry that once we get through this big reopening, there's going to be a little bit of an air pocket where growth in GDP will go back to a much more normalized level, or even subnormal if we kind of just have a retrace. And the concern there is that even though the printing of money should help silver, do you see a detraction from that kind of air pocket from the industrial demand? So again, for me, I'm in gold right now. I haven't entered any silver yet, but on pullbacks, I certainly will look at that very, very closely.
And is the gold silver ratio then something that you look at in order to form that view?
Yeah, you do want to pay attention to that. It's just one piece of the puzzle. As a technician, you never want to just focus solely on one thing, but you want to look at multiple levels. The gold silver ratio, and even like we talked about with gold Fibonacci is a great one to look at. What I try to do is when I look at buy levels on anything, whether it's gold, silver, or stocks, I always try to find multiple factors or multiple signals that are at the same price point. And if you can basically, let's say you have a gap fill or a Fibonacci retrace, that gives you one, maybe the odds of success there are 60-40, right? So 60% success at that level based on that. If you can add one or two more, you can push your odds of success maybe upwards of 80%. And, listen, nothing's going to be 100%, but if you can have trades that are at 80% success rate, you're going to be an all-star. There's no doubt about it.
And last time we talked, you had lightened up your Bitcoin. You were looking for a correction. That correction came, and it was quite a deep correction. We have in the last 24 hours seen Bitcoin dip below 30,000 for the first time since January. Now it has crept back up above that now. But what are you seeing in the Bitcoin chart? Do you think that this is a sell-off that is going to continue deeper?
Yeah, so right now you have to respect the fact that it got below 30,000 briefly and rallied back up. Now, this is kind of an institutional game that you'll see very often where, the institutions know that there's a ton of stops right below that 30,000 level. So what they do in the short term to make money is they'll push it down, crack that 30,000 level, and then rip it right back up. What they do is they take all those stop out coins and they accumulate them, and then they push it up and then start selling them back. So I think that was a game that we saw yesterday with the dip below 30,000. The way to avoid getting kind of, whipsawed with those things, look for a daily close at minimum below that level. If you get a daily close, it's less likely to be a game from the institutions, more likely to be a real breakdown. Now, in terms of projections, you can see you have another clear head and shoulder pattern here. So shoulder, head, and shoulder. If you close below this neckline, that would break it down and you would go to 25,000 and then to about 18 to 19,000 down there. 18 to 19,000 or anything below 20,000 is my strong accumulation zone. I love Bitcoin over the long term, even though I think it has more downside. As long as it holds 30,000 here, it could easily move up and down and chop sideways. Even going above 40,000 would not be outlandish. Just always watch that daily close below 30,000. When that happens, the next big sell-off should take hold. So it's an amazing chart. On a technical basis, that 30,000 is the only thing bulls have to watch. If that cracks in a daily close below, then you really want to be concerned about it going to 25 and then 20, sub 20,000.
Right. I suppose if we talk about stocks for a moment, one indices that we've seen, the Nasdaq is now making a new all-time high, which is significant for that. Now the Dow hasn't followed suit as of yet. What are you seeing in that chart?
Yeah, so the Nasdaq, and this is such a good thing for investors to understand, is that notice interest rates, we were hovering around 1.5, 1.6, even 1.7%, and tech was under a lot of pressure because as interest rates go up, what we see is a rotation of capital away from these high growth, high PE stocks into kind of the safety trades, whether it's a Disney or a McDonald's or those type of names. Boeing was one that was getting accumulated quite a bit. We've now seen interest rates pull back where we're now in the 1.4 range. And that's reignited this rotation of capital out of those kind of Boeing's, Disney, McDonald's trades back into the tech trade. And that's pushed the tech sector to new all-time highs here. Now, we do have a little bit of a doji here today, which is a signal that you could be short-term at exhaustion. The other thing that I keep an eye on here, too, is you have some key trend lines that you're now into. So one thing for today as being a potential top signal, take a look at this first one. Let me erase the second one I put on.
Sure. And just that doji is when it opens, rallies to a new high, and then sells off again and closes below the open. Is that correct?
Yeah, correct. Or puts in basically a candle where you have a tail on the top and a little tail on the bottom.
Gotcha.
If it closed at the lows today, you'd even get a topping tail, which would be even more bearish. But you're absolutely right on that. And I should really explain a lot of these terms because I understand a lot of people aren't quite familiar with them. To me, it's second nature at this point. But one thing to keep an eye on here is look at this high pivot connected to these highs and look at what you hit today. And just in terms of a short-term resistance, that would tell me that the NASDAQ has a chance of pulling back over the next couple of days. And again, the question is how deep of a pullback? Right now, you probably assume somewhat on the shallow side unless interest rates start to go up. But yeah, I mean, it's been a really amazing resurgence. The tech sector was really the laggard for multiple months. And now we are seeing, again, new all-time highs on it.
And you say that's kind of, we keep an eye on what happens in interest rates. So if we look at the bonds, if we take a look at maybe the 10-year, what are we seeing in that might give us some sort of indication as to what's going to happen with interest rates over the short, medium term?
Yeah, so I don't have the 10-year up here, but I have the TBT, which represents basically the 20-year. It's an ETF that you can buy if you're bullish rates. And again, it represents the 20-year Treasury yield. What you can see here is that you have pulled back off the highs. You've chopped around and kind of come lower. The one thing to keep in mind here is that on a longer term basis, this is actually a bullish pattern of consolidation. So you can see the big run up, especially from here to here. And then notice this trend line here. And let me see if I can get this accurately in. And this trend line right around here. And notice just so I
understand this chart, Gareth. So we are seeing rates going higher as this is selling off.
So as the TBT falls, it's telling you that interest rates have fallen.
Perfect.
Right.
Okay.
So basically look at the TBT as a representation of the 20-year yield or the 10-year. You can also just equate it to the 10-year because it's pretty close to that price action. Okay. So basically, we know that interest rates, when TBT was at the lows over here, interest rates were at 0.5%, and then interest rates started to rise quicker. We went all the way to that 1.75 on the 10-year, and now we've backed off here on the 10-year yield. Now, the key here is recognizing that this is a bullish inside bar pattern, which again, it tells you that you could have some weakness in the short term, but bullish patterns are, the term bull means that eventually it's going to break out to the upside and make new highs. So yes, you are pulling back. It's what we would call a digestion. Think about running a marathon, right? You run the 26 and change miles of a marathon. A marathon runner just can't keep running another marathon. They have to take a break. They have to refuel their bodies. And that's what this chart is telling us it's doing. So a pullback here to me doesn't say, oh, we're going to go to deflationary periods or anything like that, at least in the short term. It's telling me that you're going to see a digestion period here and then another big breakout. And I still think yields, at least over the next 6 months, could easily test the 2% level on the 10-year, especially with the numbers on inflation are so hot right now.
Yeah.
Now, I don't think they'll continue that hot, but I mean, they are insanely hot right now.
And they're the official inflation figures that we're seeing published. I mean, the reality is that real inflation numbers are probably a lot higher than are a lot higher than that. Not probably, are a lot higher than that. So in terms of the value of your money being eroded by inflation, we are going to continue to see money plowing into various different asset classes in order to protect from a depreciating dollar. So even with interest rates at 2%, it's still not going to be dissuading people to be jumping back into the bond market.
No, probably not. And like you're saying, it's something that, it really hurts the poorest, obviously, when food and energy. I mean, food prices, you can see it. It used to be kind of like, oh, the tuna can got a little smaller, and for the same price. But now it's like, I mean, you go into the store and an apple, which was, X amount is now 25% higher. And it's incredible, the inflation that we're seeing. And again, the Fed always says, oh, well, we're not going to include food and energy. But in my opinion, that's the most important because it really affects the middle class and the poorest in the country.
Yeah, food and energy tends to make up a much larger proportion of take home pay for the lower income classes.
Yeah, it really does. It really does. And again, that just brings you full circle back to why it's important to have some gold in your portfolio, some silver, and just kind of diversify. And by no means do you want to be all in on gold or silver, but it's important to just recognize that a good portfolio allocation is going to have assets, both stocks, bonds, but also things that'll protect you against, the inflation that we're seeing right now, like gold and silver.
Absolutely. And at Goldcore, we'd always echo that advice for sure. Whenever you're on, Gareth, I'd like to ask you what it is that you're keeping an eye on. Last time it was some of the Chinese indexes. Still keeping an interest for you?
Yeah, absolutely. So I still have some, I've been accumulating more and more of the Chinese stocks. Let me show my screen here and we can go over a couple of these charts. Some of them have continued to stay kind of sideways, which has been a little disappointing. But in all fairness, the Shanghai has not broken out yet. One stock that I've accumulated over the last week has been this one. It's starting to uptick a little bit. Joy, Joyy, symbol YY. That's had a steep downtrend. I'm looking for a bounce at least back into the mid 75 range. Longer term, again, I think a lot of these Chinese stocks will trade back to the highs as investment in the U.S. becomes less lucrative. You'll see an outflow of money from U.S. equities, U.S. investments, and they're probably going to look for places like China where stocks are still relatively cheap compared to the mature companies in the US trading at very, very high PEs. So names like that I like. I continue to like Viacom. It hasn't really done much, to be honest, which I've been a little surprised at. But I love the fact that, big names like David Tepper are in this and Dan Niles, big hedge fund managers. They are usually, that's smart money right there. That's even smarter than me. So, if I like it based on the chart and the valuation, and they're in it, it makes me feel even more confident, at least in the short term. So I continue to look at those. I'm net short the indices in full fair disclosure. So I'm net short the NASDAQ and the S&P, but then I have select long holdings. Just like we talked about diversifying, it's important to, you don't want to be short the indices and then short all the stocks, because then if you're wrong, you get hammered. You want to be short maybe the indices like I am, and then long select stocks that you think could perform better even in a down market.
Perfect. Now, obviously, technical analysis is your mainstay, but when you're looking at individual stocks like that, what percentage are you trading based on technical analysis, and what percentage is there any fundamental analysis?
So there definitely is fundamental analysis that comes in. Usually, it has to do with smaller stocks for me. So when I look at a small cap, for instance, you want to look at their balance sheet and make sure that they're not borderline going out of business and filing for bankruptcy tomorrow. They might have a great drug in the pipeline, but if they're going to file for bankruptcy, it's not going to matter. So for small stocks specifically, I do always look more so at the fundamentals than the technicals. When you come to stocks like Apple and Amazon and Microsoft, it's almost, I would say it's 90% technical. And the reason I say that is because you always have differing valuations in different market conditions. So, in this current market, valuations at 30 PEs are very normal for large cap tech like Apple and such. But if you get in a bear market, you'll see Apple at a 10 PE, right? So well, what's the correct valuation? What if we're entering a bear market? Then the stock should be way lower. And that's why I always go to the technicals on the chart, is because those will give me firmer levels where I can expect a bounce. And in all fairness, again, full and fair disclosure, I'm not a long-term investor. I'm much more of a swing trader. So I'm not holding stocks for years at a time. I'm more looking for, let's say, let's see here. What would be, well, I can even show this chart. So RCON here, this is a stock that I'm in currently. It's a smaller stock, but it gives us a good basis. So you can see this stock had a secondary offering they did, and it collapsed down. One of the reasons why I like it down here, if I throw in my moving averages on a technical basis, it's right at that daily 200 moving average. So do I think this company is a long-term, over the next 10 years, it's going to be a huge success? Honestly, I don't know. All I know is it hit the 200 moving average. So technically it should have some sort of bounce, maybe back to about $6 and change. And for a swing trader like me, if I can generate that profit in a month or so, that's awesome profit.
InTheMoneyStocks.com is the website. Where do you hang out on social media? Where can people follow you?
Just follow me on Twitter, at Gareth Soloway. So at my first name and last name, you'll find me there. And I always try to post some interesting charts and tidbits and ideas there. And I love interacting with people on Twitter.
Gareth Soloway, InTheMoneyStocks.com. Thank you for joining us on Gold Core TV.
Thank you so much for having me. It's been a pleasure.
Thanks for watching. And if you enjoyed this video, you'll definitely enjoy this series of interviews with experts like Jim Rogers, David Brady, and David Garofalo, the ex-CEO of one of the world's largest gold mining companies. And remember, if you want to see more interviews with thought leaders and industry experts in financial markets, subscribe to Gold Core TV and hit the notification bell now. And if you want to learn how to buy, sell, and store precious metals, visit goldcore.com, your precious metals experts.